Have you ever stopped to think about how the whole global financial system actually decides, who gets to borrow money? Or maybe what makes some companies just seem so incredibly resilient even when markets are going completely haywire?
Yeah, those are big questions. And they really point towards the essential plumbing of global finance. Today, we're actually going to dive into a company that sits right at the absolute center of all that.
That's right. We are looking at Moody's Corporation today, stock ticker MCO. But look, this isn't just our usual overview. We're unpacking a really specific, very detailed analysis that a listener sent over. It's basically an investment memo from an office of the principal, it says, dated just recently, June 14th, 2025. And it's looking at Moody's as a potential candidate for what they call a permanent holdings portfolio.
Right. So our mission here is to walk through this analysis, really unpack it with you. We want to get a handle on what makes Moody's tick, at least according to this deep dive. We'll look at its strengths, weigh those against the potential weaknesses, and ultimately see if the case laid out here really holds water. Does it stack up as a wonderful company you might actually want to own for decades?
Yeah, and the main source is this investment memo, but you can see it pulls from a whole stack of things. Company reports, investor presentations, loads of financial data. It's pretty comprehensive.
It really is. And what comes through is that Moody's is, it's a lot more complex than just the credit ratings agency you might hear about. It's got these different but definitely interconnected parts to the business. And as we dig in, I think you'll see some surprising things beyond just that, surface level image.
Okay, so let's jump right in then. How does Moody's actually make its money? The analysis kicks off describing this two-engine business model.
Yeah, that's kind of the core concept here. So engine number one, the one everybody knows, is Moody's Investor Service. That's MIS. This is the classic credit ratings agency part. Mm-hmm. Their money comes from fees that companies or governments or cities pay when they issue debt. They pay Moody's to get a rating on their bonds or, other kinds of securities.
Okay, so the people issuing the debt are the ones paying Moody's for the rating.
Exactly. And inside MIS, there are really two main ways they make money. First is transactional revenue. This is tied directly to how much new debt is being issued. Think of it as deal dependence, the naturally cyclical part.
Right. More deals, more revenue. Fewer deals, less revenue.
Precisely. But then there's recurring revenue. This comes from things like monitoring ratings that already exist, ongoing services for commercial paper programs, that kind of stuff. And that recurring bit is actually pretty significant. The memo points out that even in 2022, which was a tough year for debt issuance, recurring revenue was still 56% of the total for MIS. So that gives it this really important base layer of stability, even when markets are choppy.
Okay, so MIS cyclical engine, but with a surprisingly stable recurring core. Got it. What's engine number two?
Engine two is Moody's Analytics, or MA. And this is framed as the increasingly vital part, the higher growth segment. It's basically a data, software, and services business, really focused on a whole range of risk management and financial solutions. And its revenue model, it's heavily subscription-based. Things like research platforms, data feeds, analytical software tools.
Yeah, so this part is much more predictable day-to-day, month-to-month.
Oh, far more. The analysis highlights that in 2022, something like 94% of MA's revenue was recurring. That's huge. And it serves a really diverse set of customers, banks, insurance companies, folks needing to know your customer, or KYC, solutions, research, proprietary data. It's broad.
Okay, so you've got this classic, maybe somewhat up and down ratings business, MIS, and then this really stable, growing analytics business, MA. How do they actually fit together? Do they help each other?
Oh, absolutely. This is where the real power of the model seems to come in, according to the memo. They aren't just, two separate divisions operating independently. They're symbiotic. The analysis really stresses that the globally recognized Moody's brand, its reputation, which is massive, and especially the huge, unique pool of proprietary credit data that gets generated by the MIS ratings business. Mm-hmm. Well, those are the foundational assets that directly fuel the growth in the MA engine.
Ah, okay. So the act of rating all that debt creates this unique data, and that data becomes the raw material that powers the Moody's Analytics products.
Exactly right. MA takes that really distinctive data, blends it with technology, other data sources, and finds new ways to monetize it, expands the company's reach, its relevance. You really saw this play out in 2022. MIS revenue went down because, less debt was being issued, but the MA segment, it just kept growing. I think the memo said it hit 60 straight quarters of growth back then, and by 2024, it was up to 68 consecutive quarters.
Wow, 68 consecutive quarters of growth in analytics. 17 years.
Yeah.
That's quite something. It really shows MA isn't just some side project.
No, not at all. It's presented very much as the future engine for creating value. The analysis argues that if you only focus on the sort of cyclical waves you see in MIS performance,
Right.
you actually miss the underlying rising tide of MA's compounding growth and how it's increasingly contributing to the overall quality of the company's earnings. They explicitly call it a counter-cyclical recurring revenue growth engine.
And the memo links MA's growth to these bigger picture trends, right? Something about an era of exponential risk.
Yeah, that's the strategic framing they use. They're pushing into these high-demand areas. Things like cyber risk, ESG analytics, climate risk modeling, private credit analysis, expanding their Orbis database. That's the one with company information to cover 550 million companies. That's another example of just building out these massive data assets. The business is clearly shifting, evolving beyond just being the ratings agency towards being a subscription-based data and analytics powerhouse.
That evolution does sound pretty significant. Okay, let's switch gears a bit. Moving from the business model itself, the analysis really dives deep into the economic moat. What is it, according to this memo, that makes Moody's competitive advantages just so strong, so formidable?
Well, the source lays out this really powerful combination of advantages. First up, intangible assets. You've got the brand itself, right? Over 115 years old. It's basically a global symbol for credibility. Trust is just paramount in this space. And that's reinforced by its official designation, particularly in the U.S., as a nationally recognized statistical ratings organization, an NRSRO by the SEC. That regulatory status alone is a huge barrier to entry for any potential newcomer.
Okay, so the brand name plus that official government stamp makes it incredibly hard for someone else to just set up shop and compete.
Extremely hard. Then second, you have network effects. Think about it. The more people who use Moody's ratings, both the issuer selling debt and the investors buying it, the more valuable those ratings become for everyone involved. Issuers kind of need a rating to access the capital markets efficiently because investors and regulators rely on them. More issuers getting rated means a richer, deeper data set for investors. And more investors relying on the ratings makes them even more essential for issuers. It's this powerful, self-feeding loop that's just deeply woven into the fabric of how financial markets work.
Yeah, that makes a lot of sense. It feeds on itself. Okay, the third leg mentioned is high switching costs.
And the memo paints these as exceptionally high, like for a company or a government issuing debt, trying to switch away from an established player like Moody's or S&P.
Right.
Well, it would probably mean noticeably higher borrowing costs, maybe even trouble accessing certain investors or markets at all. And for a big institutional investor, decided to just ignore Moody's ratings, that would be incredibly risky from a fiduciary standpoint, could even open them up to liability.
So the practical cost of not using Moody's is actually way bigger than the fee they charge you.
That really gets to their pricing power.
Yeah.
And the analysis gives this really stark example. I think this was from a 2021 presentation. It showed that an issuer, by getting a Moody's rating, saves, on average, something like 30 basis points on their borrowing costs.
Okay, 30 basis points saved in interest.
Right. And what does Moody's charge for providing that rating service? Just 7 basis points?
Wait, they pay 7 basis points in fees, but they save 30 basis points in interest. So they're saving more than 4 times what they actually pay Moody's.
That's the math presented, yeah.
Wow.
And it's just a really vivid picture of the huge value gap for the customer. This gap is pretty direct evidence of how strong that moat is, and it explains how Moody's can command premium prices and, nudge those fees up over time without losing tons of customers.
Okay, those advantages sound really powerful, but is the moat just static, or is it actually getting wider over time?
The analysis argues pretty strongly that it is widening, primarily because of that strategic transformation we talked about. I mean, the core ratings moat itself is pretty stable, right? Moody's and S&P, they each have roughly 40% of the global market share. Fitch has maybe 15%. That basic competitive structure hasn't really shifted dramatically in a long time. But the overall moat around the whole consolidated company, that's what's widening.
How? By using the cash generated by the stable ratings business to build up the analytics side.
Precisely. The memo calls the MIS segment a cash flow fortress. It generates these incredibly high operating margins, over 60% in 2024, on an adjusted basis apparently, just churning out torrents of free cash flow. And management is systematically taking that cash and deploying it to acquire and build out the MA segment.
You mean like buying RMS for climate risk or Vigeo Iris for ESG stuff, or that pending deal for Kate Analytics for property data that the memo mentioned?
Those are the exact examples they cite. Each acquisition layers in a new, data-heavy, high-growth product line. And often they can sell these new services into the same customer base they already have, leveraging the Moody's brand name. This creates these sticky subscription revenue streams that have their own high switching costs. So it just expands the perimeter of the whole fortress, those 68 straight quarters of MA growth. That's seen as the tangible proof that this widening is actually happening.
It really sounds like a highly efficient, almost like a self-funding loop, doesn't it? The regulated, super high-margin ratings business just fuels the expansion of this growing, stable analytics business.
That's the core thesis on the structure, absolutely. It's designed to be self-reinforcing, funding its own expansion and making the overall company's earnings higher quality and, more predictable over the long run.
All right, let's dig a bit deeper now. What about the scuttlebutt, the sort of anecdotal evidence gathered for this memo? What does it suggest customers and employees actually think about Moody's?
Well, for the ratings business, MIS, it seems it's less about love and more about necessity. The analysis describes it kind of like a mandatory toll gate, both for the issuers who need the capital market access and for investors who need those standardized risk assessments.
So basically, you use it because you kind of have to.
That seems to be the gist of it. For Moody's Analytics, MAT, the data they pulled from sources like Comparably gives maybe more mixed picture. The Net Promoter Score, the NPS score that measures how likely customers are to recommend something, it was only +5, which, frankly, isn't great. Doesn't exactly screen passionate fans.
Yeah, a +5 NPS. That sounds pretty lukewarm, to be honest.
It does, right. But the key detail the analysis pulls out is customer loyalty, which was high at 73%. So the implication is, maybe the products aren't the slickest or the most user-friendly out there, but they are deeply embedded in customer workflows. They're considered mission critical. The memo notes that, interestingly, more sophisticated users, say in technology roles, tend to rate the product quality higher than maybe people in accounting, who might just see it as a compliance cost they have to bear.
Okay, so the value isn't necessarily in a delightful user experience, but more in just essential integrated functionality that you can't easily rip out.
That seems to be indispensable utility kind of wins out over maybe UI elegance in this case. Then on the employee side, the synthesized insights suggest Moody's is seen as a bit of a lifestyle workplace, at least within the broader finance sector. Meaning you might get better work-life balance than in, say, a super high-stress investment banking job, potentially even working less than 40 hours sometimes, perhaps in exchange for, maybe lower bonuses compared to those Wall Street peaks. There was a 2022 survey cited that found 87% felt they were part of a mission-driven organization, which is quite high.
How does a potentially lower compensation structure, compared to some other finance gigs, become a competitive advantage? Wouldn't that risk losing your top talent?
That's a really good question. And the analysis frames it as sort of a nuanced strength. Think about the core ratings business. The most valuable asset there isn't just raw brainpower, it's the experience, the judgment, the integrity of the analysts. A super high-stress, high-turnover environment. That would actually jeopardize the institutional knowledge and the trust that the brand relies on. So a culture that prioritizes stability and work-life balance, even if it means slightly lower peak pay, is actually more likely to retain those crucial long-term employees. And that retention, that accumulated knowledge, directly supports the brand's reputation for integrity, which, remember, is the bedrock of the moat. So it's seen as aligning the employee culture with the long-term goal of preserving the quality of the business itself.
Okay, that makes sense. Let's shift focus again maybe to management and the overall financial picture. The analysis seems pretty positive on the leadership team.
Yeah, it presents the CEO, Robert Fauber. He took over in 2021 as a key strength. He's actually a long-term insider. Started at Moody's way back in 2005, working in M&A. So that background means he was deeply involved in actually building the MA segment through acquisitions over many, many years.
So he doesn't just understand the strategic shift from the top down, he understands it from the ground up, having been involved in the deals.
Exactly. His stated philosophy is apparently centered on building an enduring institution, helping clients navigate all this increasing complexity by giving them a holistic view of risk. He's characterized as a leader with a real long-term perspective, prioritizing a respectful workplace, and showing what looks like an owner-oriented mindset when it comes to allocating capital.
Okay, speaking of allocating capital, how have they been deploying all that cash from the cash flow fortress?
The record highlighted looks exceptionally rational and quite shareholder-friendly. They seem to have a clear, disciplined approach to M&A. They prioritize strategic fit first, make sure the investment meets a required rate of return IRR above their cost of capital, and they target a relatively quick cash payback period, like 7 to 9 years. It's presented less as empire building just for the sake of size, and more as methodical value creation, aimed squarely at building out that MA segment.
Right, using those strategic acquisitions we mentioned earlier to keep expanding the MA footprint.
Exactly. And importantly, when attractive M&A deals aren't available, they have a strong track record of returning cash to shareholders. They have increased their dividend for 16 years running now, while keeping a sustainable payout ratio, around 30% of earnings. And they're also very consistent share repurchasers, big buyback plans announced year after year.
Like the memo mentioning $1.0 billion planned for 2024 and significant amounts before that, too.
Yes, those figures are cited as evidence of that commitment to buybacks. So the analysis concludes that management really passes the rationality test. They invest strategically to widen the moat, and they return excess cash efficiently.
Okay, now let's look at the financial health itself. Is Moody's actually a financial fortress, according to this analysis?
Qualitatively, the memo strongly suggests it is. It's called a reliable earnings machine, mostly because of its asset-light business model and that strong moat we discussed. It shows high and stable profitability. For instance, in 2024, they reported record revenue $7.1 billion, with a really impressive adjusted operating margin overall, 48.1%, and the MIS segment specifically. That operates with exceptionally high margins, like in the low 60% range. MA is strong too, in the mid-30s%.
Wow, those are really high margins for pretty much any kind of business.
They really are. And looking at key quality ratios, return on invested capital, or ROIC, is described as exceptional. The analysis cites a normalized ROIC of 22.32%, and one research source mentioned even over 60% historically. Now, the exact number can vary depending on how you calculate it, but both figures are extraordinarily high. They indicate significant economic value creation.
Yeah, that's often a sign of a truly superior business. What about generating actual cash flow?
It's described as a prodigious free cash flow generator. Net income converts into free cash flow at a very high rate. Something like 30% of sales was cited in one report, and often near or even above 100% conversion from net income. This just provides tons of flexible cash for them to reinvest or return to shareholders.
And the balance sheet, are they loaded up with debt?
Nope. It's characterized as prudent and conservative. A net debt to EBITDA ratio of just 0.7x was cited in one report, which is an exceptionally low level of leverage. And recent balance sheets seem to confirm that leverage remains pretty modest. This financial strength lets them easily ride out economic downturns and also be opportunistic if M&A chances pop up.
Okay, so we've covered the business model, the moat, the scuttlebutt, management, the financials. Now we get to the big question. Price versus value. What does the analysis say about the valuation right now?
Well, as of mid-2025, when this memo was written, Moody's was definitely trading at a premium. The trailing price-to-earnings, or PE ratio, was around 41 to 42 times earnings. Price to free cash flow was about 35 to 37 times.
Okay, and how does that stack up against its own history?
It's definitely above its historical averages. That PE is noticeably higher than its 5-year average, which was around 36x, and its 10-year average of about 34x.
So on the surface, at least, it looks kind of expensive compared to where it usually trades. Is the argument that it's actually a fair price today, despite that?
That's the crucial judgment call presented in the analysis, yes. It argues that for a truly wonderful company, valuation isn't just about looking backward at historical averages. The current premium might be justified because the market is perhaps only now starting to fully recognize that structural transformation we've been talking about, the shift towards the higher growth, more stable MA segment.
Right, so the thinking is, maybe you're paying a higher multiple today, but you're actually buying a higher quality, more resilient, and probably faster growing business than Moody's was, say, 5 or 10 years ago.
That's exactly the argument being put forward. The quality of the consolidated earnings stream is improving, the total addressable market they can go after is expanding, and the overall moat is widening. So it might not look like a statistical bargain based on historical metrics alone, but for an investor thinking in terms of decades, this price for an ownership stake in what's presented as a financial fortress with exceptional returns on capital and durable advantages, well, it's considered fair. It's framed almost as the price of admission you have to pay for one of the world's truly premier businesses.
So what does the analysis really pinpoint as the main engine for future growth from this point forward?
It's very clear on this. It's the continued expansion and, crucially, the deep integration of that Moody's analytics platform. This isn't just about selling more subscriptions to existing products. It's about leveraging their unique data, that powerful brand, and their established customer relationships. do basically become the indispensable operating system for managing complex risk on a global scale.
And the specific areas they're really targeting for that.
Yeah, they're focused on what they call integrated risk assessment, giving clients a kind of 360-degree view that connects risks that used to be looked at separately, like KYC, climate risk, cyber risk, supply chain risk, linking them all together. Achieving dominance in these high-growth niches, like KYC and ESG climate analytics, is seen as key. And critically, leveraging generative AI across their products. They mentioned an internal research assistant tool and potentially more customer-facing AI applications down the line. The goal is to embed Moody's even deeper into how their clients operate day to day.
Okay. Now, despite this pretty compelling bull case that's been laid out, the analysis is also careful to identify real, genuine, long-term risks. You know, the kind of factors that could potentially cause a permanent loss of capital for someone holding this stock for the long haul.
Right, the permanent impairment risks, as they call them.
What are the key ones identified there?
The first one highlighted is reputational collapse. I mean, the entire business fundamentally relies on trust and the credibility of that Moody's brand. The 2008 financial crisis and the serious criticism Moody's faced for its ratings on all those subprime mortgage assets back then. That's the vivid reminder of this vulnerability. So a future scandal or another major rating failure, maybe in a new complex area like private credit or AI-linked derivatives, who knows, that could severely damage the brand. It could erode that crucial intangible asset part of the moat. The analysis calls this the most significant existential risk they face.
Yeah, that makes total sense. Trust takes forever to build and can vanish overnight, especially in finance. What's the second major risk?
Adverse regulatory change. The credit rating industry, particularly the MIS side, operates in what's effectively a government-sanctioned oligopoly. That's largely due to regulations that require many investors to use ratings from these NRSROs. So a big shift in the political climate or the regulatory environment could lead to new laws. Laws designed to break up this structure, maybe impose utility-style price controls on fees, or dramatically increase the legal liability if ratings turn out wrong. Any of that could permanently damage the exceptional economics of that core MIS ratings business.
So the very regulations that help create the barrier to entry also make them potentially vulnerable if those regulations change.
Exactly. It's kind of a double-edged sword that comes with being a regulated entity like this. And the third risk they flag is technological disruption. Now, Moody's is investing heavily in data and AI themselves, but the analysis considers the possibility that some completely new technology could emerge. Like, imagine a decentralized AI-native credit scoring protocol, maybe built on blockchain somehow, that turns out to be significantly more accurate, cheaper, and faster than the legacy rating models. It's a long-term risk, but something like that could potentially render their core methodology or even their delivery mechanisms obsolete over a very long time horizon.
Okay, let's try to apply some second-level thinking here. How does the view presented in this particular analysis compare to what you might call the general market consensus on Moody's?
Well, the prevailing market view, generally speaking, is often that yes, Moody's is a high-quality business, it's got a wide moat, but it's fundamentally cyclical. Its performance is seen as really dependent on the global volume of debt being issued, which obviously fluctuates with interest rates, economic cycles, things like that. So a lot of market analysis tends to focus on predicting short-term issuance trends and macro forecasts.
And the view in this memo is different from that.
It's presented as being contrarian, mainly in its emphasis. While it fully acknowledges the cyclicality of the MIS segment, the analysis argues that the market fundamentally underestimates a few things: the speed, the strategic importance, and the overall impact of Moody's transformation into this data and analytics powerhouse. The perception is that the consensus view is still kind of anchored in the past, primarily seeing the company as just the ratings agency.
Yeah.
Whereas this analysis sees it as a rapidly evolving integrated risk software and data company.
Okay, so the market might be too focused on the visible cyclical waves of ratings revenue washing back and forth on the surface, while maybe missing the stronger compounding rising tide of MA's growth happening underneath it all.
That's precisely the analogy used in the memo. And this perceived misappreciation by the broader market about the company's trajectory and the improving quality of its earnings that's seen as potentially creating the opportunity for a long-term investor. An opportunity to buy into a business whose fundamental durability and earnings quality are arguably improving faster than its historical valuation premium might suggest.
Okay, let's try and bring all of this together then. Based on this deep dive into the analysis, what are the core arguments for owning Moody's? The bull case in a nutshell.
All right. The bull case really points to owning an irreplaceable asset that operates within a global government-sanctioned oligopoly. That's huge. It highlights the successful, ongoing transformation into a high-growth data and analytics powerhouse, fueled by the core business. It emphasizes the exceptional financial strength, high margins, high ROAC, strong cash flow, conservative balance sheet. It points to rational management that allocates capital well, and it aligns the company with these enduring global trends around risk management and data needs.
Okay. And the bear case. The main reasons for caution or skepticism.
Those really center on, first, the demanding current valuations trading above its historical averages. Second, that existential reputational risk that's just inherent in the ratings business model. Third, the significant threat of adverse regulatory changes that could challenge that sanctioned oligopoly structure. And fourth, just the lingering cyclical headwinds that will always affect the core ratings segment to some degree.
The analysis also included something called a red team challenge, basically trying to pinpoint the single most compelling argument against the bull case. What did it identify as that core vulnerability?
Yeah, this is where the analysis really tries to isolate the central fragility, the potential weak spot. The whole investment thesis, especially when you're paying a premium price, relies heavily on the idea that the moat is permanent and the integrity is solid. But the red team challenge zeroes right in on the issuer pays conflict of interest as the potential Achilles heel.
So pointing back to the issues around 2008, but seeing it as a fundamental structural issue, not just a mistake they made in the past.
Exactly. The argument isn't just they messed up in 2008. It's that the fundamental conflict, the fact that the company being rated is the one paying the rater, is a permanent, unresolved structural flaw baked into the business model itself. The nightmare scenario envisioned is some future financial crisis, maybe sparked by something complex and emerging, like private credit getting into trouble, or weird AI-linked financial products blowing up. A crisis which exposes new, large-scale rating failures.
And the consequence of that kind of failure would be
a severe public and political backlash, potentially even more intense than what happened after 2008. And under that immense pressure, regulators might finally act decisively. Maybe they break up the oligopoly structure. Maybe they impose utility-like fee regulation. Maybe they even create some kind of public ratings utility. In that scenario, the century-plus-old brand premium could just evaporate. The moat would be effectively breached. The high-margin business model could be permanently impaired.
So the company itself might survive, but it potentially goes from being this wonderful high-multiple business to maybe just being a good business, trading at a significantly lower valuation. And that would result in a permanent loss of capital for the investor who paid that premium price.
That's the potential catastrophic outcome highlighted in the Red Team Challenge, yes. That inherent conflict of interest, according to this specific counter-argument, is the most significant long-term risk that could undermine the whole investment thesis.
So, stepping back, why does going this deep into one company like Moody's, or really analyzing any business through this kind of structured lens, why does that matter to you listening right now?
Well, it's really about learning how to systematically evaluate companies, how to understand the nature of competitive advantages and how durable they might be, how to assess management quality, how they allocate capital, and how to think critically about the real risks involved. These are skills you can apply far beyond just this one single company.
It really is. It serves as a great template for analyzing potentially enduring businesses. Which brings us to a final thought for you to consider, one drawn directly from the tension that runs right through this whole analysis. Given the undeniable enduring power of that core credit rating model and the really exciting structural growth story in the analytics business, balanced squarely against that inherent conflict of interest sitting at the very foundation of the ratings business and the very clear memory of the 2008 crisis, is the moat around Moody's truly a permanent fortress? Is it really capable of withstanding any future storm? Or does paying today's premium price for MCO potentially expose you to the risk of that moat's eventual, even if it's distant, breach? Is the price of admission for what looks like a premier business truly worth the risk posed by its foundational vulnerability?